Warren Buffett may seem like the calmest man in finance, but behind the scenes he's preparing for a market crash. His interviews signal the quiet before the storm. On the surface, they're reassuring, but if you listen closely, there's a hidden plan underneath. He's not waiting for the market to rise, he's waiting for it to fall. Today, I am pulling back the curtain on Buffett's silent crash strategy. The clues are all there if you know where to look. But where does this strategy begin? It starts with one key move that Buffett has been making for years: building a war chest of cash, preparing to use it when the market is at its lowest. One of the clearest signs that Warren Buffett is preparing for a market crash is his growing cash reserve. Right now, Buffett is sitting on over $270 billion in cash at Berkshire Hathaway, a massive amount. Historically, when Buffett accumulates this much cash, it's not because he's unsure about where to invest, it's because he's waiting for the perfect opportunity. An opportunity that only comes when the market takes a nosedive.
So, he was here this weekend, and we talked about that. How much cash do you have on hand at Berkshire right now? Is it about $48 billion?
Counting everything except the regulated subsidiaries, we probably have around $47 billion, something like that.
You like to keep $20 billion on hand,
right?
So that still gives you $27 billion to play with.
Yeah, and we could raise more pretty fast.
How?
Well, we could raise some by debt, but we can also raise some by selling some securities. We've got well over $100 billion of securities, and well over 100. We've got over 150, but as far as that's concerned, but so we could come up with. I'd like to be challenged on that.
This clip may sound like financial housekeeping, but in reality, Buffett is revealing a key part of his crash strategy. He's holding far more cash than necessary. In fact, as of this video, he's sitting on that $270 billion in liquid cash. And this isn't by accident. The liquid cash sitting on the sidelines is strategic. Buffett knows that when the market crashes, many investors will panic and sell off assets at a deep discount. That's when he plans to strike, using his enormous cash reserve to buy undervalued companies. Historically, Buffett's cash pile has always grown before major crashes. In the 2008 financial crisis, Berkshire Hathaway made some of its best deals when Buffett used his cash to reinvest in companies like Goldman Sachs and Bank of America, securing lucrative terms while everyone else was scrambling. The message here is clear: Buffett is getting ready for something big. Like he always says, we don't try to time the market, but we do believe in being prepared. And sometimes, that means holding a lot of cash until the right opportunity comes along. Here, Buffett acknowledges that he doesn't play the guessing game of trying to predict exactly when the market will fall. Instead, his strategy is about being patient and ready to act when the time is right. This philosophy is crucial to understanding Buffett's hidden crash plan. He doesn't need to know the exact moment of a crash, he just needs to be prepared when it happens. However, cash reserves are just one part of the plan. Buffett is also paying close attention to the broader economic environment, particularly interest rates and bond yields. Which brings us to the 10-year Treasury yield and how it fits into his overall cash strategy. A major signal that Warren Buffett is preparing for a market downturn can be found in his observations about the 10-year Treasury yield. Now, Buffett has admitted that predicting interest rates isn't his strong suit. However, his recent comments suggest that he's paying very close attention to the yield on the 10-year U.S. Treasury note. Why? Because when bond yields are this low, it typically signals an overheated market, and Buffett knows that's a recipe for disaster.
Let's talk a little bit about what Joe was just mentioning. I had not seen the 10-year yet this morning. He talked about how it's at 2.57%. Why do you think that is? Is this a sign of concern about what's happening? What would be your guess?
I don't know. I'm no good on interest rates, but the one thing I know is 10 years from now they won't be at 2.57 or probably at 3.57.
Does it catch your attention, though, when you see the 10-year continuing to decline? Because most people thought it would definitely have to go up this year.
Yeah. It's surprising, but I'm used to getting surprised in markets. And you know, we issue bonds from time to time, so the lower rates are, the more we like to issue them, and the longer we like to issue them.
So would a 10-year at this level change any of your behavior in the business? Would you do anything differently?
No, we don't do anything differently. If it moved up 50 basis points or down 50 basis points, we would not do anything differently. We don't react to macro factors at Berkshire. Our macro factor is that the country is going to do a lot better over time, and that guides us in everything we do.
Again, I know it's not something you sit around spending a lot of time thinking about, but if you had to make a guess right now, would you guess that the 10-year would end the year above or below 3%?
I really don't think about that, but yeah, if you told me I had to pick a figure, I'd pick higher.
In this clip, Buffett downplays his ability to predict short-term interest rates, but don't let that fool you. What he's really pointing out here is a critical economic factor. Interest rates this low cannot last forever. Historically, when interest rates have stayed low for too long, it creates dangerous conditions for a market crash. Investors chase riskier assets, driving prices to unsustainable levels. And when the Federal Reserve eventually raises rates, the bubble bursts. Buffett's approach to the 10-year Treasury yield is subtle but important. While it may not dictate his investment decisions, it is a key piece of the broader market puzzle. Low bond yields signal that investors are willing to accept minimal returns in exchange for perceived safety, which often leads them to inflate the stock market. And that's exactly the kind of overvaluation that Buffett watches closely before making any of his big moves. When these warning signs appear, it's often a precursor to a crash, and that's when Buffett prepares to buy. For Buffett, this is a clear warning sign. While other investors are chasing sky-high returns in today's low-interest rate environment, Buffett is being cautious. He's not rushing into risky assets because he knows that the higher the market climbs, the harder it will eventually fall when the interest rates rise. Interest rates and bond yields aren't the only indicators that Buffett watches. Another major part of his strategy is Berkshire Hathaway's unique structure, which gives him the flexibility and power to act decisively when the market turns. Let's explore how this structure plays into his hidden crash plan. Warren Buffett's crash plan isn't just about being cautious or holding cash. It's also about the structure of Berkshire Hathaway itself. Unlike many other companies, Berkshire is designed to give Buffett the flexibility and freedom to act quickly when market opportunities arise. This unique structure is one of the reasons why Buffett can confidently wait for a crash without worrying about external pressures.
There are real advantages to having the company together. I mean, the one big advantage is the ability to allocate capital from businesses where it can't be used effectively. Maybe the present capital can be used effectively, but incremental capital has very little value, and we can move that over to other areas which have capital needs beyond the amount they're generating themselves. So capitalism is about capital allocation. The whole idea is putting resources in the right places, and we've got the ability to look at 70+ companies, various industries, and everything else, and allocate capital wherever it makes the most sense. And most companies are, if they're in the XYZ business, they feel that they look at the opportunities in XYZ, and if they can't find any good ones, they may do some ones that aren't quite so good. And if they need capital, they may have to go to capital markets and incur the expense of that. So we have a seamless, very efficient way of rearranging capital among businesses, which in aggregate will spend like $12 billion on capital this year.
This clip shows a crucial part of Buffett's strategy. While most companies are locked into specific industries or have limited flexibility, Berkshire Hathaway operates more like an investment portfolio. With over 70 companies under its umbrella, Buffett can reallocate capital as he sees fit. If one business doesn't need extra cash, he can direct those resources towards businesses that do, or more importantly, save that cash for future investments. This structure gives him the power to act swiftly during market downturns. Take the 2008 financial crisis as an example. While many companies were scrambling to survive, Buffett was able to inject billions into struggling companies, securing incredibly favorable terms. Why? Because Berkshire's structure allowed him to mobilize capital quickly, without needing approval from a board of directors or shareholders. This agility is part of his hidden crash plan, being ready to deploy cash exactly when the market is panicking. Berkshire Hathaway's independence from the financial markets is another key advantage. While most companies need to issue debt or sell equity to raise funds for big investments, Buffett can tap into Berkshire's internal sources. This is why he always talks about keeping a minimum of $20 billion in cash reserves. But in reality, it's much more than that. Because Berkshire's businesses generate so much cash, Buffett can raise far more than $20 billion quickly, which he has recently shown. This internal flexibility is a secret weapon in his crash plan. It means that when everyone else is scrambling for liquidity during a downturn, Buffett is ready to step in with offers that companies cannot refuse. It's this kind of thinking that allowed him to get equity stakes in major companies like Bank of America and Goldman Sachs during the latest financial crisis, deals that continue to pay off today. While Berkshire's structure gives Buffett the tools to act quickly, he also pays close attention to the geopolitical instability. While Warren Buffett doesn't let short-term geopolitical events dictate his investment decisions, he's always aware of how global instability can impact the markets. Geopolitical events like trade wars or military conflicts can lead to significant market volatility, and Buffett knows that these moments often create opportunities for those who are prepared. He knows how broader forces might drive a market correction, and how to position himself to capitalize when that happens. Buffett's approach to geopolitical instability is methodical. He doesn't react emotionally to breaking news or sudden market swings, but he keeps his eye on the big picture. Events like the Ukraine crisis or US-China trade tensions can affect global markets, and Buffett understands that these events often create irrational selling. Buffett's famous saying, "Be fearful when others are greedy, and greedy when others are fearful," becomes especially relevant during times of geopolitical turmoil. When the markets are driven by fear, Buffett sees opportunity. He knows that the large-scale geopolitical events can create temporary disruptions in stock prices, and that's exactly when he steps in to buy valuable companies at discounted prices. In 2020, for instance, when the COVID-19 pandemic sent markets into a free fall, Buffett didn't rush into chaos. Instead, he sold certain holdings, naming Berkshire Airlines stocks, realizing over $4 billion, as he believed the industry's future was too uncertain. At the same time, he built up a massive cash reserve, holding a record $137 billion, waiting for the right opportunities. Buffett made his first major move in July 2020, acquiring $10 billion worth of natural gas assets from Dominion Energy, expanding Berkshire's foothold in the energy sector. Additionally, rather than buying heavily into new stocks, Buffett repurchased $24.7 billion of Berkshire's own shares, signaling his confidence in the company's long-term value. Now that we've seen Warren Buffett's hidden crash plan, the big question is, how can you apply these principles to your own investment strategy? While you might not have billions in cash reserves or own a diversified portfolio like Berkshire Hathaway, the core strategies Buffett uses can still work for any investor, especially when it comes to preparing for market downturns. The key to investing isn't predicting what the market will do next week or next month. The key is to understand what you're buying and prepare to hold it for the long term, no matter what happens. Buffett's first piece of key advice is simple. Don't try to time the market. Instead of focusing on daily stock fluctuations, pay attention to the fundamentals. A strong company with durable business models will weather short-term storms and emerge stronger. For individual investors, this means choosing companies with a durable competitive advantage, strong profitability, and good management. Understanding a company's intrinsic value allows you to confidently hold through market downturns, just like Buffett does. Action step 1. Focus on quality. Buffett's strategy emphasizes investing in high-quality companies with strong economic moats. Look for businesses that dominate their industries, like Coca-Cola, Apple, or Amazon. These companies have proven their ability to grow even during tough times. As Buffett says, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Action step 2. Stay calm during crashes. Keeping your cool during market crashes is one of the hardest parts of investing. When others panic and sell, Buffett stays calm, knowing crashes often present buying opportunities. As he says, the stock market is designed to transfer money from the active to the patient. If you've invested in quality companies, stay patient, and trust the market, it will recover. Action step 3. Build your cash reserve. While you may not have billions like Buffett, having a cash reserve allows you to take advantage of discounted prices during downturns. Even a modest cash reserve gives you flexibility to buy when the market dips without selling your assets. This positions you for long-term gains once the market recovers. Buffett's hidden crash plan is all about preparation, not prediction. Focus on building a portfolio of strong companies, keep some cash ready, and be prepared to act when market opportunities arise. As Buffett says, the goal isn't to predict when the next crash will happen, it's to be ready when it does. Now that you know this, click the video on the screen to see how Warren Buffett used this strategy to turn $100,000 into a $20 million portfolio.